Hello, I'm Cliff Walsh, Chief Investment Officer at American Portfolios and Portfolio Manager of the 9 Points Investment Strategies. In this video, I'll give you a quick overview of the fourth quarter and discuss what we're seeing in the financial markets today. 2019 was a banner year for investors. It started off much like 2018, off to the races to start the year, but thankfully finishing quite differently. It was the best year for the equity markets since 2013, with all major U.S. equity asset classes up more than 25%, with the S&P 500 leading the way, up 31.5%. The Fed took a much more dovish tone in 2019 than we anticipated. While we did not believe that the Fed would raise interest rates 3 to 4 times last year, we were surprised by the unusual late cycle reduction of rates. This was a huge buoy for the financial markets and should be a tailwind for economic growth in 2020, but not necessarily financial market growth. Despite the great year, we do find it interesting and a little bit concerning that the entire 31.5% return of the S&P 500 was driven by multiple expansion, with earnings down slightly. The international equity markets lagged, seemingly as per usual, with developed equity up 22% and emerging market equity up 18.4%. Slower growth in developed markets, concerns over Brexit, and less central bank activity relative to the U.S. were likely the main drivers behind the lower performance. When looking at the broad fixed income indices, it was the best year since 2002, with the U.S. aggregate bond index up 8.72%. Long duration bonds and high yield led the way with 18% and 14% returns, respectively. Our view for 2020 economic activity in the U.S. is for the recent slowdown to bottom and begin to rebound, albeit modestly, in the middle of the year. Recession risks, which grew significantly throughout most of 2019, have diminished recently. This is due to the Fed rate cuts and support of the repo market, along with easing trade tensions with China, as tariffs have likely peaked. Barring an external shock, it appears as if the start of a recession has been pushed out. We do wish to point out, however, that given less cushion from lower interest rates and the recent rally in safe haven assets like long duration bonds and gold, we think the downside in the financial markets during the next recession will be greater than average. This has been a very unique cycle. The stock market's correlation to GDP has been ridiculously low this cycle, as multiple expansion and share buybacks have driven equity returns during a low GDP growth environment, making it difficult for fundamental investors. The economic expansion since the bottom of the great financial crisis has been the weakest and lowest quality expansion on record, fueled by debt and Fed actions. The correlation between GDP expansion and financial market performance has been less than 10% during this cycle, while the correlation between the markets and Fed actions is closer to 70%. We expect this correlation to continue for some time, but we think the Fed's impact on the financial markets could be more muted in 2020 than it has in recent years. As we look at 2020 and the Fed's potential interest rate moves, the wait-and-see approach is likely to persist in our view. A change in rate policy appears unlikely at the current moment, only likely taking place if there were substantial surprises, either good or bad. I'd like to take a moment to touch on a few international economies as well. We expect economic activity in the Eurozone to continue on its lackluster path. Real GDP growth of around 0.75% to 1.25% seems like a good target to us, with inflation increasing at a similar rate. Germany is showing signs of recovery, and while not a major beneficiary of the U.S. trade deal with China, stronger trade partners likely means there will be a positive spillover effect in Europe. Brexit remains the key downside risk to this already weak forecast. Should the exit be more difficult than is currently expected, the fallout could be significant. Japan is likely to see continued lackluster economic activity as increased government expenditures is offset by a VAT tax hike implemented last year. Given negative interest rates and the massive amounts of quantitative easing efforts that have taken place in years past, make it appear as if there's little the Bank of Japan can do to stimulate the economy. While we see China's growth slowing in 2020 and expect a lower growth rate to persist in the long term, we believe a U.S. trade deal will be a positive boost for China and other Asian emerging markets. In China, we expect central bank policies to be neutral, with the potential for modest rate increases over time, offset by support of the shadow banking system with capital infusions and the broader economy through exchange rate adjustments. Broader emerging markets appear stronger than they have in a few years, with solid balance sheets and inflation at an all-time low, and have more central bank ammunition than China or any developed market. This has us cautiously optimistic that the emerging markets could outperform the broader indices in both equity and debt. On the geopolitical front, with Phase 1 of the trade deal signed, we see the risk of a trade war lessening and believe that both sides have incentives to make progress on additional phases before the U.S. elections. Should talks somehow break down or China back off, perhaps hoping to get a better deal from a Democratic challenger, we would expect to shave some growth from our forecasts and see a pullback in the equity markets. We believe the most important event of 2020 is likely to be the 2020 U.S. election for control of both the presidency and the Senate. Regardless of which Democratic candidate gets the nod to battle with President Trump, all of the major Democratic frontrunners propose a reversal of the 2018 Tax Cut and Jobs Act, which dramatically cut federal corporate income tax rates. While we view legislation banning stock buybacks as highly unlikely in the event of an administration change, despite the rhetoric calling for it by some, a reversal of recent bank deregulation could also take place. Other areas that could see increased regulation include the technology and healthcare sectors. A handful of pundits are calling for double-digit gains in the U.S. financial markets in 2020, citing renewed growth and a history of strong markets during election years. We see a path to a 10% return in the S&P 500 in 2020, but it appears a less than likely path, dependent on at least 10% earnings growth in 2020 and 2021 and no multiple contraction, all of which we view as unlikely. We expect 2020 to be a below-average year for equity returns, certainly before the elections. Already high expectations, rebounding but still muted growth prospects, and less Fed ammunition all give us pause when considering our year-ahead market forecast. We see geopolitical risk, economic fundamentals, and sentiment as being the key drivers of returns and volatility in 2020. Barring a recession or a surge in inflation, we see the Fed playing a lesser role than it has in years past. Have we seen the peak correlation between the Fed and financial markets? We're not so sure, but we do believe it will decline in 2020. Overall, we view 2020 as more of a stock picker's market, with subsector and factor performance likely driving more divergences than it has in years past. I hope that you found this market commentary helpful. As always, please feel free to reach out to me or Manager of Due Diligence, Sam Rossi, if you have any questions or would like to discuss 9 Points Investment Management. Thanks for watching.